Hello everyone, Ugodre here, and this is my Money Brief. On today's Money Brief, I want to talk about interest rates. I'm sure you're all aware that the Central Bank Monetary Policy Committee, that is a group of people who decide the direction of the interest rates, had their last meeting on the 24th and 25th of November, and made some startling decisions. And these are decisions that essentially shocked a lot of analysts. So they decided that they were going to keep the benchmark interest rates, which most people call a monetary policy rate, at 27%. Now, why is that shocking? Well, a lot of us thought they were going to cut those rates. I was one of them. But they didn't cut the rates. They left it at 27%. We're going to get back there in a bit. They also decided to retain the cash reserve ratio at 45% for banks. That's basically how much of your deposit banks get to keep with the CBN. So that is at 45%. And then for merchant banks is 16%. They also decided to retain cash reserve ratio for non-TSA public sector deposit at 75%. I don't want to bore you with what that means, so just leave that aside. Liquidity ratio, of course, was 30%. But more importantly, just as important as the MPR, they did decide to keep the asymmetric corridor at plus 50 minus 450 basis points. Let me explain what that means. When the central bank says they're keeping the asymmetric corridor at plus 50 minus 450. What it means is when the central bank lends money to banks, that plus 50 is 0.5% or 50 basis points. So they lend to banks at 27.5%. Okay. Now, they also said they've also reduced by 450. So it means when they borrow from banks, they borrow from banks at 27% less 4.5%, which is about 22.5%, if my maths is correct. So that was the decision of the MPR, and everyone was surprised and shocked, at least a lot of people, if it's not everyone. So why did the central bank decide to take such a decision? That's what this Money Brief really is about. Think about it. Interest rates have been falling generally, whether it's the Treasury bills rates, bills rates, FGN bond rates, fixed deposit rates. Rates have actually been falling. And more importantly, we've seen inflation numbers fall drastically over the last few months. Headline inflation number is currently at 16.05% for October. Most people believe it probably would hit 15% plus by the end of December. Of course, we'll know that by January. So inflation seems to be trending downwards. Then it kind of sounds counterintuitive that the central bank has decided to keep rates the same. I mean, at 27%, what it then means is manufacturers who rely on banks for loans, or small businesses who rely on loans to transact their businesses, are still going to be borrowing at stupendously high interest rates. As you all know, if you try to get money from a bank, you're probably getting money from a bank at 30-something% interest rate, which is very difficult for anyone who want to do business with 30-something% annually. Microfinance banks probably worse. Some are even giving loans at 6% monthly, 6% flat. And that is also because interest rates are at 27%. Now, but the CBN did explain why, and as much as it does sound crazy or maybe weird, there could actually be some logic to the entire madness, as they say. So why is the CBN doing this? You really do need to look at the minutes of the MPR to see exactly why they took this decision. And there is some subtle languages, subtle things the CBN governor did mention that kind of looks like, that must be the reason why they decided to keep rates the same rather than reduce it. And I did read that NPR statement, and I'm going to read some of the things that they said here, so that we can discern together. So at one point they said the committee's decision was underpinned by the need to sustain the progress made so far towards achieving low and stable inflation. Now, underline that word, sustain the progress made so far to achieve low and stable inflation. So that kind of sounds like they know that the monetary policy is working, but they're not confident that it has gotten them across the line that they're looking for. So yes, interest rates have been pretty high. It's contributed to the reduction of the inflation numbers, but it's still not where they want it to be, and so they want to sustain it. Now, there's something else they also said. They said maintaining the current, this is probably the most important one, maintaining the current stance of policy amidst lingering global uncertainties, underline that word, amidst lingering global uncertainties, would allow the effect of the previous policy rate hikes to sufficiently transmit to the real economy and further reduce prices. It kind of sounds really strange. Let's break it down. So, lingering global uncertainty. So the central bank knows there are a lot of things happening globally that they can't control. They really don't know what the impact could be on Nigeria. So there's no point celebrating too early that, inflation numbers are 16.05%, so we should be happy about that. Let's start cutting it. As much as we've gotten things under control, let's remember that a number of things we don't have under control. For example, we can't tell foreign investors when to bring their money in. And foreign investors bringing their money in depends on what's happening globally, global uncertainties. And so there's a lot of global issues, even in security in Nigeria. There's Russia, Ukraine still fighting. There's geopolitical issues going on globally. There's pressure to cut interest rates in the West. We're not even sure. Even in the US as well, they are not even releasing their own numbers too. Just a few days ago, they decided they were going to release some of their job numbers and some of their headline numbers that everybody waits to see. So there's just a number of uncertainties that they are not comfortable with. That is probably one of the reasons why they've kept rates stable. And then they said that these things could affect the previous policy rates. So they don't want anything that would affect previous policy rates. So maintaining the rate was important. Remember, rates were had been 27.5% for months before they cut to 27%. So the fear is, let us don't do things that will affect all those high rates that we've done, so that you don't have a situation where it doesn't transmit to the real sector. So yes, rates have gone up, but what they're saying is that a lot of companies are still reeling, which means companies still spend quite a lot of money. Costs haven't really gone down for a lot of businesses. Yes, we're seeing prices go down here and there, but core inflation hasn't really gone down that much, which I've always said is the key inflation number I like to look at. So while food inflation is down, core inflation, which really affect business, is not down yet. So they are looking at this as probably one of signs that they probably need to maintain rates. But I think there are probably two other reasons why this keeping rates the way it is, happened. One is FX. Now, Nigeria is still not out of the woods when it comes to FX. Yes, we've seen FX stability over the last few months. We're all happy about it. 1.450, sometimes 1.470, but it's been around that range for the last few months. And we've seen external reserves go up to record levels, multi-year record levels. So we're all happy things are picking up, but it could all change. At the moment, Nigeria attracts more foreign portfolio investments than foreign direct investments. And foreign portfolio investors only come into Nigeria because of your high interest rates. Okay, our high interest rates. The last Eurobond that they did it at 9 point something percent, almost 10% Eurobond, which actually thought was expensive, but you know what? That's the reality. So I kind of think it's important that they keep rates high because they also want to send a message to foreign investors that, yeah, we're seeing inflation numbers go down, but we still want to keep that real interest rate pretty high, which is real interest rate is the difference between the official interest rate, which is 27%, and the inflation number, 16.05%. So that's what they're trying to do. And there are examples of this happening elsewhere. Ghana, inflation interest rate is around 22% or so. The inflation numbers is 8%. So Ghana has been able to bring down inflation numbers to single digits, but their monetary policy rate is pretty high. I do understand that they could cut it by the time we're done taping this show. So that is probably one thing that the central bank also have at the back of his mind. But there's a second reason. And that reason is that there's still a lot of money out there. There's about 117 trillion in money supply. How did this happen? Well, let's remember all those intervention funds, all those ways and means that spending that happened during the Buhari years and the Emefiele years. That money is still in circulation, and that money is fueling some of the spending that we're seeing across the country. Banks have clawed back some of that money in deposits, but there's still a lot out there. And let's also remember that there was a drastic devaluation, 750 to as much as 1.8. So that is people who have dollars. If they convert that money in Naira, that's still a lot. And that's what a lot of people have done. So all that money is still out there. And if you're not careful about the way you keep rates down, that could actually fuel another run on the Naira, which means people could just start now buying dollars again. Because after all, there's really no point holding Naira. So that kind of sounds like the reasons why they have done this. Of course, they've given us the official reasons, which I've explained, but I kind of feel these are other reasons. The central bank has a lot more data than we do. So the best analysts can do is basically just explain. They have a lot more data. They see a lot more things that we do. And even though we find it hard to make sense of what they're saying, but I kind of feel this is why they're doing this. I mean, it's bad, I know, for manufacturers. We've gotten a lot of feedback from them. This is bad for economic growth. They feel like high interest rate means they can't borrow, they can't expand. And we do need economic growth in Nigeria to create jobs. For us, a lot of us to feel some of this, things are getting better in the country. Because you do need interest rates to go down. But I guess the message here for all of us is, and I've always said, this is a year for equities, meaning it's a year for you. If you're looking for funding, look for funding that is not debt related. Look for equity. Equity is expensive, like they say, but in an economy where equity is as expensive as debt, then you probably just want to go for equity, not debt. Because debt is at 30-something%. That is just incredibly high interest rate. That's probably what you get for an equity investment. So why go for debt when you can go for equity? Now, some smart companies, bigger ones that have the financial muscle are going for commercial papers. That's what you're seeing them doing, massive commercial papers. Some are even doing as much as 100 billion naira in commercial papers at interest rates that are way lower than what banks are given. Short-term interest rate, because there's just so much money out there, and a lot of these things are oversubscribed. So if you're a manufacturing company, you're sound, you have good products, people know you, you have good ratings, you might want to tap into that commercial paper space because interest rates are likely going to remain high at least till February next year when the MPC meets again. Until then, you probably want to look at other areas or other ways of getting cheap capital. This has been MoneyBrief. I hope that I've been able to explain this. If you have better ideas, or maybe you have other reasons why you think the CBN decided to keep rates flat, to let me know. Oh, by the way, someone did say that the fact that they reduced their asymmetric corridor by 450 basis points and increased by 50 basis points on the other side, that's the standing lending rate, suggests that they indirectly cut it by 200 basis points, whatever that means. But anyway, you get the message here. The CBN is basically telling us this is no time to celebrate. Tighten your belts. things are going to be pretty tight until February. The silver lining here is that with this sort of decision, it's really, really hard to bet against your Naira. Be careful out there. Don't get burnt. Until we do this again next time, do have a profitable week ahead. Bye.